journey in your last two. I swim with tea when they turned in. The staring down to mute. And can lend a pole that some kid died.
Retirement planning for a corporate owner-manager is very different from retirement planning for a typical employee. During the working years, most people receive income from a single source, such as employment. But once a business owner reaches retirement age, several different income sources begin working together, making tax planning much more complex. Let's look at Michael's situation. Michael is 67 years old. He owns a successful nursery business and has decided to continue working even though he has reached retirement age. His corporation is still earning profits, but at the same time he has also become eligible for several retirement income programs. As shown on the left side of the slide, Michael may receive dividends from his corporation, Canada Pension Plan benefits, old age security payments, and eventually income from his RRSP after it is converted into a RRIF. Each of these income sources flows into his personal bank account, and almost all of them contribute to his taxable income. This is where retirement tax planning becomes much more challenging. Instead of asking how to minimize tax on a single source of income, we now need to coordinate several different income streams at the same time. The right side of the slide highlights the major factors involved. Canada Pension Plan provides taxable retirement income. Old age security can be reduced if total income becomes too high through what is known as the OAS clawback. RRSPs eventually must be converted into RRIFs, which require mandatory annual withdrawals. And if the owner continues operating the business, the corporation may still pay salary or dividends. Individually, none of these income sources is a problem. The challenge arises when they all occur together. As total income increases, the owner may move into higher tax brackets and may also lose part of their old age security benefits. The income meter at the bottom illustrates this perfectly. As retirement income grows, tax planning becomes less about minimizing this year's taxes and more about managing total lifetime income. Every additional source of income can affect both the tax payable and eligibility for government benefits. This represents an important shift in thinking. During the accumulation years, the goal is often to maximize savings and defer taxes. During retirement, however, the goal changes. The focus becomes coordinating withdrawals from different sources so that total taxable income remains as efficient as possible over many years. In the next slide, we'll examine one of the biggest retirement planning mistakes made by many owner-managers. We'll see why continuing to maximize RRSP contributions right up to retirement can sometimes create larger tax problems later, especially after RRSPs are converted into RRIFs. At first, maximizing your RRSP every year sounds like the perfect retirement strategy. You receive an immediate tax deduction, your investments grow tax-deferred, and your retirement savings continue to increase. But for many corporate owner-managers who continue working into their late 60s, this strategy can eventually create an unexpected tax problem. Let's follow Michael's journey shown at the top of the slide. At age 67, Michael is still actively working in his corporation. He continues paying himself a salary and continues making maximum RRSP contributions each year. On the surface, everything appears to be going well. His RRSP balance keeps growing, and each contribution helps reduce his current income tax. However, Canadian tax rules require every RRSP to be converted into a registered retirement income fund, or RRIF, by the end of the year in which the individual turns 71. Once that happens, mandatory withdrawals begin. Unlike an RRSP, where withdrawals are optional, a RRIF requires minimum annual withdrawals whether the owner needs the money or not. Now consider the example in the middle of the slide. Suppose Michael has accumulated an RRSP worth approximately $1,200,000. After converting it into a RRIF, his first mandatory withdrawal at age 72 could be around $64,800. But that's only one piece of the picture. Michael is also receiving Canada Pension Plan benefits, old age security, and possibly dividends or salary from his corporation because he continues to own and operate the business. When all of these income sources are added together, his total taxable income rises significantly. As illustrated by the income meter, Michael's total retirement income may now exceed the old age security clawback threshold. In other words, even though he successfully built a large RRSP, part of his government benefits may now have to be repaid through the OAS recovery tax. At the same time, more of his income may be taxed at higher marginal tax rates. The warning cards at the bottom summarize the three major challenges. First, higher taxable income means more tax each year. Second, RRIF withdrawals are mandatory. You cannot simply choose to leave the money invested if you don't need it. And third, those larger withdrawals may reduce or even eliminate your old age security benefits. This teaches us an important principle of retirement tax planning. Bigger is not always better. The objective isn't simply to accumulate the largest possible RRSP. The objective is to minimize taxes over your entire lifetime while creating flexibility in retirement. A strategy that saves tax during your working years can sometimes create larger tax costs decades later if it isn't coordinated with your other retirement income sources. In the next slide, we'll look at a more balanced approach. Instead of allowing RRSP balances to grow unchecked until mandatory withdrawals begin, we'll see how gradually drawing funds earlier and coordinating them with corporate dividends and government benefits can produce a much more tax-efficient retirement income plan. We've now seen the potential problem of allowing RRSP balances to grow without considering the tax consequences later in life. The good news is that there is a more flexible approach, one that focuses on managing lifetime taxes instead of simply maximizing tax deductions during the working years. The first part of this strategy is to begin planning earlier. Instead of waiting until age 72, when mandatory RRIF withdrawals begin, the owner-manager can choose to withdraw modest amounts from their RRSP during their late 60s or early 70s. By making controlled withdrawals while they are still in relatively low tax brackets, the overall RRSP balance gradually decreases over time. As shown in the timeline at the top of the slide, Michael begins withdrawing about $50,000 each year starting at age 67. These withdrawals are entirely voluntary and can be adjusted each year based on his overall income. By the time he reaches age 72, his RRSP balance is smaller, which means the mandatory RRIF withdrawals will also be smaller. The second part of the strategy is balancing multiple sources of retirement income. Instead of relying heavily on one income source, Michael combines Canada Pension Plan benefits, old age security, controlled RRSP withdrawals, and corporate dividends whenever additional income is needed. This gives him something extremely valuable: flexibility. If one year his taxable income is already approaching the old age security clawback threshold, he can reduce RRSP withdrawals or postpone corporate dividends. In another year, if his taxable income is lower, he may choose to withdraw more. Rather than being forced into one rigid pattern, he can adjust his income to suit his tax situation each year. The benefits shown in the middle of the slide all work together. Smaller RRSP balances lead to lower mandatory RRIF withdrawals. Lower RRIF withdrawals make it easier to stay below the OAS clawback threshold. Coordinating multiple income sources provides greater control over taxable income and often allows the owner to remain in lower marginal tax brackets throughout retirement. Notice that corporate dividends become an important planning tool rather than the primary source of retirement income, because the owner controls when and how much dividend income to receive. The corporation provides another layer of flexibility that most employees simply do not have. The timeline at the bottom summarizes the complete journey. During the working years, the corporation accumulates savings. As retirement approaches, thoughtful RRSP planning begins before mandatory withdrawals are required. Throughout retirement, multiple income sources are carefully coordinated to create stable cash flow while minimizing taxes and protecting valuable government benefits. The key takeaway is that successful retirement planning isn't about maximizing every savings account individually. It's about making all of your retirement assets work together. By coordinating RRSPs, government benefits, and corporate income, a business owner can often reduce lifetime taxes, preserve old age security, and enjoy far greater financial flexibility throughout retirement. This is exactly how experienced tax advisors think. They don't optimize one account, they optimize the client's entire retirement income strategy.